All right, cash flow basics. Let's just dumb it down. It'd be very simple. It's cash coming in and cash going out. And you'll be surprised at how many business owners and their finance team do not actually do a great job of that, especially when you get into the accrual accounting method, and you're dealing with receivables and payables and inventory management, basically your cash conversion cycle, right? That time it takes to convert $1 of sale into actual cash. So moving forward, this is basic stuff, cash flow statements, right? One of three key financial statements, right? You have the income statement, you got the balance sheet. It really complements those two, but in my opinion, it's the most important one. So it's going to summarize these movements of cash. You can go all the way down to the three. If anybody's taken accounting class, right, you're going to go over basically these, and I cannot tell you how important it is as a business owner that you know what's going in and out of your cash flow statements. So you have your operating. There's different methods of a cash flow statement, but this is probably the most traditional one where you're going to see it broken down into three components: operating, investing, and financing. Right, so your operating, that's your sale of your goods or services, whatever it is that you're going to do, and as an entrepreneur. Wages, rent, supplier payments, those are your operating cash flow statement. Your investing, right, your asset purchases, right, you're going to purchase maybe some equipment, real estate and whatnot. So the example here is that you're going to purchase a new oven to make pizza. I like pizza, so that's my picture there. Or you might sell equipment, right? Maybe you might have depleted a piece of equipment. You want something new to expand and scale up your operation. So you might sell something. So you might see a cash inflow there. And then financing. So that's your cash plus or minus, right? So maybe you might issue a dividend to your investors if you're making a lot of money, or a distribution, or you're going to be raising equity capital from your investors, or you might also get cash from the bank or from a lender. So that could be a plus. And then when you're paying that loan back, right, that's going to be cash outflow. So that's going to be in your financing statement. So that's kind of your three core components of your cash flow. I'll pause there for a second. Anybody have any questions on this slide or the prior slide?
Nope. I have a question.
Yes. So for example, when a business apply for the loan from the bank, so what they look into is like the potential profit of that business or the real cash flow of that business. Which one that they look into?
Was the question the real cash flow or the potential?
Potential profit.
The potential profit. We'll take a stab at that.
Yeah, so I think just always keep in mind, I think like kind of, and that correlates perfectly with our presentation today. So cash flow is king, right? So ultimately, we'll definitely pay attention mostly to cash flow, but as you mentioned, right, the profitability and especially the profitability potential of said business is also important when we kind of look at it from more of the subjective perspective, right? As far as when we go to our credit approvers, the decision makers within the bank that ultimately say yes to making these loans, that's important because it helps them to believe in the story, right, in the long-term perspective of the business, and this is why we should finance, X, Y, Z.
Yeah, so it's going to be both, but the demonstrated and actual cash flow is going to be more important. There's going to be nuances. So I would say history is going to be more important than projection, but we will always want to know projection, especially if the economic conditions are challenging. Say we're in a recession, so maybe there's macro variables that are putting pressure on the whole state or the whole economy. If you have very positive projections, we're going to want to know why, right? Why are you going to achieve growth when maybe the rest of the market is going down? There are nuances to where, okay, let's say there's no history, but the potential is very high. How is that potential? Is it contractual? Do you have a contract that is locked, solid, right? That you're going to get these recurring revenues. We can model out your profit potential. That might be something you may be willing to lend against. So there's nuances where maybe there wasn't any history, but if there is a contract and we know that buyer is money good, right? Maybe it's a federal contract or whatever. I could think of probably some other examples that would make sense. But in that case, there might not be any history, but we may be willing to take a risk and lend on that potential. Now, the bank's going to want some security, right? We're going to want guarantees from the owners. Maybe if they own a house or another asset, we will say, hey, you gotta pledge that asset. and we'll give you a favorable loan, right? Not a high interest, high risk loan, because the banks are not really in the business of doing that. And then if the business comes through with that potential, then it'll repay the loan and it'll be fine.
Thank you.
Great question. By the way, good to see you again. I remember you were at last year's presentation. So.
Yes,
Sure.
I came here last year, but this year I canceled come.
Oh, you did. But this is going to roll into EBITDA. Thanks a lot.
So, like we mentioned earlier, right, the EBITDA number is like very important when we're looking at cash flow because it provides a really good benchmark, easy to calculate, and it's one of those things where it's universal. You can utilize it in a variety of different ways, which Kyle's going to touch on in just a few moments. But just wanted to kind of start from the basics, right? So how do we get to this mystical EBITDA number? So we have our income statement here, and what we did was we kind of built it out. So you can kind of, if you have your own statements and you want to back into your EBITDA number, this is how you'll do it. So first off, we start with earnings, right? The E8, which is basically your net profit. Then you add a couple of other items. So interest, taxes, depreciation, amortization. And again, just plug them right from your income statement and just add it right back into that net profit value. So ultimately, that's going to leave us with our EBITDA number, $187,000. So I'm going to pause it. Hope I explained it clearly, but did anybody have any questions on kind of how we got to that number? Solid. Okay.
So, go ahead. Daniel and I live and breathe this. We are literally doing this every single time a business submits their financial statements. A lot of times a business will only give us an income statement and a balance sheet. They don't always have a cash flow statement, especially small business. More sophisticated, larger businesses, they have CFOs or maybe going to get an audit report or a CPA financial statement that's prepared by the CPA accountants, and they can do a cash flow statement. I don't see why QuickBooks or something couldn't generate this for business owners, but this is a sort of simplified profit and loss statement, and we will take that and deconstruct it and get your EBITDA, which is your rough measure of cash flow, operating cash flow. That's what that is.
So as a business, can we make our own decision about the depreciation and amortization? Or like there is a rule that we need to follow?
Yes, there generally is accounting standards and guidelines for depreciation expense depending on the asset that you have. So, and there's a difference between GAAP, general accepted accounting principles, and tax accounting, okay? So there's differences there. And you have to be cognizant of that, right? So on the tax side, you might have the bonus depreciation potential where you can depreciate 100% of the equipment that you purchase in order to shelter your income from paying tax, right? So there's that on the tax side.
Mm-hmm.
On the, let's just call it company prepared or GAAP accounting, you're not going to have a bonus depreciation. You typically have to follow a schedule, right? So maybe, just for example, real estate, I think might be a 40-year, is that right? Ballpark. Yeah, I think it might be a 40-year schedule, right? So you have to take that asset and it's got to be equally depreciated over that 40 years, right? Equipment might be a schedule that's something less. So there's going to be guidelines. You can't just sort of come up with that number. That said, depreciation or amortization is a non-cash expense. So it doesn't really matter what that amount is because we're going to add it back because it's non-cash, right? That's a non-cash expense. So whatever this number is, in theory, the larger it is, it's going to reduce your income before taxes, which then reduces your tax payment, right? That's sort of what's happening on your tax filing side, right? If you're going to have bonus depreciation, you might have a different number than what this is here, but just know it's irrelevant to us because we're looking at your cash flow, your operating cash flow. It will have some, to take it a little bit further, the depreciation has a little bit of relevance in that if all of your fixed assets are depreciated, that usually is a signal that you might need to purchase new fixed assets, right? There's episodic expenditures of capital expenditures that you might have to purchase to refresh your equipment, because when you buy a pizza oven, for example, you're not going to buy a new pizza oven every single year. It's going to deplete and it's going to wear and tear over 10 or 15 years. And then in 15 years, you're going to make a larger capital expenditure to replace that equipment, right? And so depreciation is kind of sort of over time, it's in theory maybe a certain amount of money that you should be saving and socking away in order to buy that piece of equipment again when you need to, in order to refresh your assets of your business to then help you operate. So just know on the balance sheet side, there are some implications where it's okay, if everything's been depleted down, what are the condition of these assets? What's the rest of the useful life is what we like to say.
Yeah. Thank you very much.
Right. Okay, so Daniel and I as bankers, we live in this number. It's one of the key metrics, and that's why we're teaching it. So here are some real world applications, right? When you figure out whatever your EBITDA number is, there's different valuations for different businesses, but generally investors, private equity, let's just call it the investment market, likes to value companies based on a multiple of EBITDA. So this is arbitrary, 7 times EBITDA, but that is a very common multiple that we might see. It might be 5 times, it might be 8 times. And that's dependent on a number of different factors of what a valuation of your business might be. But if you figure out what your EBITDA is, you might be able to figure out a valuation of your business as a multiple of cash flow of EBITDA. Does everybody understand that? Okay. Now, lending, okay, so a bank. We also like to lend against a multiple of EBITDA, and we want to be conservative, so we may never go above 3 times EBITDA. That's a very common threshold for banks. And that's just purely based on cash flow, okay? So if you're gonna buy real estate, the bank might look at a different metric for leverage to finance that asset. We may lend a little bit higher multiple of EBITDA because we have the security of a high quality asset such as real estate. But in general for this class, 3 times is pretty much an upper limit of what a bank may want to lend against EBITDA. So if you do $100,000 of EBITDA, we may only want to lend you $300,000 of a loan, of a business loan. Maybe that's to buy equipment or financial working capital. So cash flow leverage, so a bank is going to take that number and we're going to look at our debt, right? So the same example I just gave you, 300,000. If you had 100,000 of EBITDA, that's 3 times, right? 3 over to 1. And then what we also like to do is we like to look at repayment capacity. So, as a bank, when we're looking at making a business a loan, we're looking at that business's ability to repay that loan. How do we do that? We usually take EBITDA or some variation of that number, and we'll divide that by the interest expense of the loan, right? And so we obviously need to see that be above 1 in order for that to be a positive relationship, to have us feel good about the loan. And as the business operates every single year, we're going to be measuring that every single year. Larger the loan, we're probably going to measure it every quarter. So that's to assess the health and repayment ability of the business to pay the loan. So, I mean, that's a little bit of our world and kind of how okay, so why has the investment market and banks, why have we kind of gravitated to this? Well, one, it's a rough measure of your operating cash flow, so it's kind of an easy back of the envelope method to figure out what your operating cash flow is. But it's also agnostic to tax and capital structure, right? Because we're looking at EBITDA before taxes, okay? And we're also looking at it typically before you make a distribution and before you make interest payments on any debt. If you have no debt, then there's no interest payments, right? Your business that you set up, maybe it's a C corporation, so you're going to pay taxes at the corporate level, or maybe it's an S corporation, and it's going to flow through individually. Or maybe you set up an LLC, a limited liability corporation, and you might tax it at the member level, or you might tax it at the corporation level. You can choose the distinction there on an LLC. So we like to look at this to sort of ignore, right, what's happening, because maybe you're not even paying any tax. Maybe you have net operating loss carry forwards that prevents you from paying tax or shelters you. So that's why we've gravitated towards that metric. It kind of allows us to have an apples to apples comparison of businesses, even nonprofits per se, on what their EBITDA cash flow is.
So I guess the question here is we are calculating cash flow and why we exclude depreciation and amortization. Also, exclude interest and tax. I understand if we count back or add back the depreciation and amortization, if not, we will cash flow out. But for interest and tax, it's a cash flow out. Why we need to exclude it? Get all money.
Yes. So the reason why we exclude it is we want to see that metric before those payments are made. Because typically when a business comes to the bank, we're looking to change the interest payments, right? They're going to come to us and say, hey, I want to refinance my debt, right? Replace the old loan with a new loan. So we don't care what the old loan was paying. We care about what the new loan is that we're going to give you. And we know what interest rate we're going to charge. So we sort of put that away to figure out what is the actual reality of the interest payments that will be made based on maybe this customer coming in and what they want to do with their debt. Now, let's say they have 3 loans and they only want to refinance one of them, then we're going to take those other 2 loans and we're going to carry that interest forward. So then we'll look at EBITDA and then we'll have the interest expense that we know will be certain for that future year, plus whatever interest expense we will have in whatever new loan. And we come up with a pro forma interest expense. And then we're going to deduct the interest from that EBITDA. And then there should be a positive number left over, right? And that's what we're evaluating. So because the interest expense might have a variableness to it, it might change. We want to look at what is the actual future pro forma interest that's going to be occurred, that will be deducted from EBITDA. So, and we're also going to take into account maybe capital expenditures. So if a business has high capex, always buying equipment, we're still going to look at EBITDA before depreciation, but then we'll also ask the business owner, what is your capex expense? What are you going to buy next year? What do you need to buy every year in order to maintain your business? So there's something called a maintenance capex number, which is typical for lenders. We want to know what is the ongoing every year expense that you need to make. And then we also like to understand growth capex. So say the gentleman asked about potential profit, right? If the business is a very high growth projection, well, typically that means you're probably funding capex at a higher rate than what you need to maintain your business. You're likely buying whatever it is you're going to buy, more vehicles, more equipment, and that's to support higher revenues, right? So we want to see that because we want to know how much cash you really have to start funding your business. And that's the danger. That's sort of the slippery slope that business owners get into, is they actually may not realize how much cash they really need to fund their business and to grow it.
Okay, I'll just add on to what Kyle said. And actually, that's an excellent question because I think what we're teaching today is kind of more just kind of base level, but what you alluded to, and it's something that we deal with pretty commonly with more complex corporate clients, is that EBITDA number might need to account for other items, right? Like, so Kyle mentioned about CapEx, for example. Like those things we can eventually construct into our analysis. But ultimately, I think this is the heart and soul of everything that we're doing when we're looking at a potential client, potential lending opportunity.
So go to the next slide. I didn't realize that this slide actually had some of the things up here. So to your question, we're going to start with EBITDA. That's the core. Everybody should know how to calculate that and know what it is. But yeah, it's your proxy free cash flow. And then here are some of the more typical cash transactions that are happening, plus or minus, right? So we're going to look at EBITDA, and then we're going to subtract cash taxes that you might have to pay, right? So that will reduce that number. Distributions to owners. So we might say, okay, do the owners need distributions every year because they need to live their life, right? Because we're going to look at the owners, and we're going to pull their credit. Do you have a house payment, right? Do you have kids? Are they in a private school, paying tuition? Right? I mean, there's all these considerations that come into distributions to owners. If they don't need to take a distribution, that's great. But unfinanced capital expenditures, right? So that there we go, CapEx, right? We want to look at, okay, what does your business need to fund to truly operate? So we may want to know that number. And then, yeah, there could be other cash sources or uses that based on unique situations. But the prior slide and this slide is really trying to bring home that it really starts with EBITDA, and then we typically will look at other major cash sources or uses that the business needs, because every business situation is going to be unique and different. But we will take into these top 3 here are pretty common.
think one thing to keep in mind too with regards to these items, these additional items on top of EBITDA, is are they recurring in nature, right? So like, say for example, you're contemplating a potential bank loan. If you have a propensity to do distributions and to pull out all the money from your business year after year, that's something that will probably be baked into our assumptions because of historical projections. So just something to keep in mind, right? As you start to plan for future expansion, future growth for businesses, these are some nuances that we're going to key in on, and it'd just be helpful just to keep top of line.
So the prior slide of EBITDA is operating cash flow. What we're trying to show here is a back of the envelope simple method to get your free cash flow, right? Because you're going to have your operating cash flow, then you might make distributions, pay taxes, and then finance, or actually it's unfinanced, but capital expenditures. What's left over, that's going to be very close to what your free cash flow is. After everything has been settled, cash in and cash out, what remains, right? Is that a positive number? Then you have positive free cash flow. That's a good thing.
True.
Yeah, so it's a more accurate estimate of cash flows versus EBITDA. It is the proxy free cash flow method. And we just did that to show you that there's a back of the envelope, kind of an easy way to try to compute that for yourself.
All right, so next up we have sustainable growth rate, which we'll touch on at a high level, but it's important to kind of an important concept in connection with cash flow because oftentimes with startup businesses or even kind of businesses that are on the uptrend, growth is the ultimate goal, right? So one thing to keep in mind, right, is with regards to the sustainable growth rate, it helps to kind of estimate if the business were to retain any kind of internally generated revenue. How fast and how quickly can my business grow without putting ourselves into a precarious position? Right, so essentially what it's saying is, hey, no bank loans, no external financing. It's essentially the business will just self-sustain. And what does that growth rate look like at a max clip? So a high sustainable growth rate, it's kind of similar to what we would want to see with any kind of attractive business, right? So you're looking at high margin products, you're looking at very good inventory, just cash flow management in general, and this healthy cash conversion cycle, which we're going to touch on the following slides. But overall, the sustainable growth rate is one of those things where if we grow too fast, as you can see at the very bottom, you can essentially grow into bankruptcy. So I'll give you an example. Oftentimes we have kind of startup product companies, right? So maybe you're starting up and you're making candles. Okay, it's great, right? Because you're getting sales. It's a popular trend, right? Maybe you're on Instagram, everybody's finding out about it. You went viral. All of a sudden, you get a call from Walmart. Like Walmart is the king of retail, right? They're all over the place. You know you're going to make a ton of sales, a ton of money, right? So it seems like a positive. But with sustainable growth rate, this is something you want to keep in mind, right? Because what is the negative of doing business with Walmart? Well, first and foremost, they're going to expect as low cost as possible from the supplier, aka us, supplying to them, right? So they're going to stretch those margins thin, which is one of the SGR attributes that we're talking about. They're also going to push out their payment terms, right? So they're going to pay you within 30 to 90 days. So that means that we foot the bill. Our cash is already spent on this product that we're supplying to Walmart, and we're supplying a huge bulk amount of product to Walmart, right? We're footing the bill for 30 to 60, 90 days, right? So essentially what's happening is, even though we know at the end of the road, we have the potential to make major sales, major cash, how do we get to that point in the interim? How are we supporting ourselves? How are we supporting our business, our day-to-day costs to get to that end point? So essentially, that's where we're going with this, with bankruptcy, right? You can essentially have a dream client, but if our business isn't in the right position to support ourselves cash-wise, we'll go on with it. Yeah, you can answer that, Pat.
No, just high growth can be, it has its dangers of not being appropriately funded. So if you don't have the liquidity, either as the investors to inject that capital, or if a bank isn't there with a working capital line of credit, right? There's a certain point where you're spending all this money on the inventory and you're booking a lot of revenues, but all that cash is then tied up in receivables. And you don't have that cash. You got to make payroll. Right? Maybe the interest payment's due on your loan. And so, businesses can get caught by growing too fast if you're not careful. So you have to manage that. And that's where a customer like Walmart, although it's great at high volume, it could be very thin margin. And you have to assess that for yourself and what may be best for your business at a certain situation in time based on how capitalized you are.
That
Yeah, so we mentioned this in the previous slide, the cash conversion cycle. And I'm sure all of you have heard about it in some shape or form, either through class or even through actual, practice through business. But this is ultimately important when it comes to, like Kyle mentioned just now, with business liquidity. And again,
I know.
So just kind of a diagram, high level of what the cash conversion cycle is, right? So essentially, like we use the topic of Walmart just now, right? So we have our accounts payable days, which is essentially how long it takes the supplier, or how long it takes for the supplier/vendor invoices to be paid, right? So essentially, that would be for Walmart, they're stretching that out as long as possible to not have to pay us. Right? Inventory days is the number of days that a company's inventory is going to last, right? So how quickly from the time that we're purchasing that product all the way to the time the product is sold, what time frame does that look like, right? So shorter is better. And then accounts receivable days, like Kyle just mentioned, right, is that amount of time it takes for a company to collect payment of sale. So essentially from when that product is sold to when we receive cash. So in the Walmart example, right, this would be the 30, 60, 90 day mark. They're going to stretch out their AP days, and then for us, we're essentially absorbing it on our side with our receivable days. So in this situation, this is a little bit more typical of a business where you're going to essentially purchase the inventory, you're going to sell it, you're going to purchase the inventory and sell it, and then you'll have maybe a little bit of a time period from when the customer receives that product to when they actually pay you in cash, the cash inflow. And then in the interim, we'll have a little bit of a flow here with an AP days, right? So from when we receive the product to when we pay our suppliers. So this difference, this cash conversion cycle right here, this is the total amount of time that we as a business have to absorb and be able to survive, right? Having enough sufficient liquidity for these types of products, just product churn. How do you guys?
Yeah, I mean, the formula is down here, right? Inventory days plus your AR days minus your AP days. That's going to give you a certain number of days, and that is your cash conversion cycle, literally how many days it takes you to turn your sale into cash. As you peel away this onion, you get more sophisticated treasury management, larger companies. So they're gonna really evaluate certain things. Like when you purchase inventory, you're gonna get an invoice from the supplier, and maybe they give you incentives, right? You pay within the first 10 days, they give you like a 2% discount, right? So there's formulas and there's more complicated things that you can do to kind of figure out what is the best value for your money. Do you stretch out and pay them at the last day possible, or do you pay them on that 10th day to get the 2% discount, right? And you're going to do the same thing potentially on the other side when you're making sales, right? You might give incentive to your customers to pay early, right? Maybe you're a credit card payment system, so you have no receivables, but then you're paying merchant fees and credit card fees and whatnot. And so that's going to be a little bit of a clip on your revenue side. But those are the things, on the front end and the back end of this thing that when you start getting more sophisticated businesses, we see them really start to look at this cash conversion cycle, and they're really trying to juice everything out of what they can squeeze. So, this I think is a good primer and a good base level, but this is very important to understand as you start to grow a business, you have product or services that you're selling. This is really important. And this is where a working capital line of credit from a bank helps fund this cash conversion cycle. If there's any takeaway, once you start getting to a mature type business, you should always have access to liquidity. You should borrow from the bank if you can when you're a credit-worthy business that can do that, even if you don't need the money to have a line of credit. It's like a credit card for a business. The fees for that are pretty minimal. Right? And then of course, you're going to pay interest when you start borrowing, but to have that in place as sort of a safety net, it's a very good idea to have. Because when you need the money, sometimes the bank doesn't want to lend it, depending on your situation. So having a line of credit and making sure that you personally have liquidity is very important, and it's going to prevent you maybe from that bankruptcy situation. This is how anyone I feel.
Excuse me, can you explain a bit more about your advice? Like, even when the startup don't need money now, the startup should borrow some money from the bank to build up the credit score, right, of the staff, right? Is it your advice?
Is that, well, usually banks would not finance a venture. Okay, so that's one. Normally, the bank capital is going to step in when the business is a little bit more mature. And that's because we're accepting depositors' money, right? We have to be very prudent stewards of that money when we lend it out. But my advice would be get a line of credit when you are first eligible and able to get a line of credit, right? Because you're only going to pay the interest when you actually start borrowing on that line, right? So if you're able to get one, my recommendation would always be to get one. It's a safety net. It's an emergency source of capital. You know, banks may not like it if you're borrowing money when you hit a snafu and maybe a challenge in your business, because that might present risk. But as a business owner, if I'm on your side of the table, that's exactly what it's there for. It's there for your working capital, but also maybe to get you through a situation where maybe your receivables, your customers aren't paying you on time for whatever reason they might have, right? So you have to float that period of time if you're not flush with cash on your balance sheet. So, you know, even large, you put it this way, large, very credit-worthy businesses always have lines of credit, and they're massive. They are massive. They're huge, and they hardly ever use them, but they have them for those reasons. So as a small business, think like a bigger business, right? As soon as you're able to qualify for one, you should get it. And you know, we at the bank we have our business sport products, and you know those rates might be 9-10%. It kind of depends on the business. But as you mature and you graduate and you start getting these bigger lines of credit, you know the interest rate will come down, and it'll change as the interest rate in the market change. But I'd rather have that line and pay somebody 8%, knowing that I have a safety net behind me, than to potentially risk not being able to make payroll.
Yeah, just that's what Kyle said. It's kind of an odd paradox, right? Where I think a lot of businesses, especially those that are growing really fast, tend to have a propensity to be debt avoidant, right? Like they don't want to take on the actual interest payment. Why take on interest when I can just pay it off? But oftentimes, as we see with a lot of different businesses in the economy, I'm sure you guys have seen numerous examples of this. Businesses need money when they're in their worst position, and don't need money when they're in their best, right? So essentially, like Kyle mentioned, the lines of credit are great because it's a safety net. I'll give you an example. So recently, at the end of last year, we had a client that went through some hardship, and this saved their business. So luckily, we had an established line of credit. They were a really strong borrower. They didn't really need it, never really used it. But hardship came up, they tapped on the line, thankfully it got them through the hump, and now they're doing a lot better. But had it not been for the line, we could probably be talking about maybe downgrading them internally within the bank. Maybe we would have had to force them to pay off their outstanding debt. Maybe they would have gone bankrupt. Like who knows, right? But essentially, like that one move, that savvy move from their CFO was open up the line of credit ahead of time when rates were down. They were overall as a borrower, they were very well positioned, so we could offer them attractive rates, and they tapped on that line to save themselves, right? So like these are things that it might seem a little counterintuitive, but again, just kind of little tips, you know, as we progress along, you know, it could be very helpful for your guys' businesses as well.
Thank you.
A follow-up question. So I don't know if that's true. I heard if the company want to buy tool or machine and they want to get it, is it still hard for them to get the loan to buy the machine or tool? Because even if it's a collateral, but it's not worth for the bank. I mean, it's not that very valuable to the bank, so it's hard to get a loan to buy machine at all.
I missed some of what you said. Banks will then, so when we rewind the slides and go to EBITDA, we're going to look at sort of cash flow ability and what's the repayment ability of a business. And we'll take the situation, the request. Okay, what equipment are you trying to buy? And then we're going to look at that and finance that and run the scenario of what's the repayment and interest rate and all that. And so the cash flow of the business, the history of it, has to demonstrate the ability to repay the loan. And that's really going to determine whether or not the bank will make that loan or not. They'll look at other things. They'll look at all the other debt maybe the business has. And if there's too much debt, that might be perceived as too high of a risk. So there's a lot of different variables as to why a bank may or may not loan the money, but loaning for a piece of equipment is a very common and acceptable request for a bank to consider the loan. But they're going to look at those other attributes that we had on the prior slide, like the debt to EBITDA number, the repayment ability, right? EBITDA over the interest expense. Those are the credit attributes that are going to matter. Yeah. How long the business has been in place. There's a number of things that Daniel and I and the teams at the bank will kind of look at to assess the decision to approve or not approve.
Yeah, I think kind of like what Kyle was just mentioning, right? I think from a bank perspective, just to kind of impart the way we're looking at potential deals, cash flow is always the number one thing that we're looking at, right? That's our primary source of repayment for the debt. Secondary, maybe even tertiary source would be the saleability of the equipment, for example, right? But I think first and foremost is if that equipment is cash positive, if it's a positive to the business to help them to reach their revenue growth, revenue potential, of course, we'll look at it from a more favorable light, especially historically, right? Because the business has probably had that equipment or had some sort of need for similar equipment in the past, which has demonstrated, hey, there is a sustainable need for this. But I hope that answers your question.
Thank you. Great. Slide.
Anybody else have any questions? Okay, all right, next one. Okay, so we're going to go over just a pretty simple example of how to maybe use the cash conversion cycle to your advantage. I'll bring up, pause there, right? Etsy phone case. But let's use a bigger company, Tesla. Okay, pre-orders, right? Before they even made the vehicle, they're getting orders and people are putting deposit money down. Well, Tesla gets all that money, right? They get to potentially use that money. So in this scenario, whatever your business situation is, if you're able to collect on a sale before you have to pay your vendor, then you're using that working capital. You're using your customers to essentially finance part of your business. So Etsy phone case, we just came up with this arbitrarily. $100, that's a very expensive phone case. If you pre-sale, let's say you had something you were selling on social media, your online store, whatever it is, and you collected that payment immediately, and you didn't necessarily have that inventoried, and then you pay for that phone case, you had a supplier that was willing to give you 20, 30 days, right? So you could pay that manufacturer for that later after when you collected the sale. Let's call that sometimes negative working capital position. Because you have a liability, but you don't have a receivable, you have the cash and you're using the cash. So there's a difference in timing there, right? So understand, sometimes it might go the other way if you're savvy enough as a business to figure out how to collect on sales before you might have to pay the vendor for the manufacturing of that product. So, you'll see that show up in different business models. Okay, any questions? All right, so I think we're going to go over a case study.
Yep, so just to kind of give you a quick primer on the case study before we jump into it, Colin actually constructed in Excel, so we kind of take you through step by step, but just kind of build the story behind what we're trying to accomplish. So we came up with a startup confectionery business called Kalo Confectionery. That's a fun on the ASB Kalo, by the way. Anyways.
Tough audience.
So anyways, the purpose behind this is, hey, we have an ultra premium Swiss chocolate company, that we're trying to create top-ranked chocolates to sell throughout not just Hawaii, but also throughout the world. So we're funding it with $520,000 in investor capital just to get the business right off the ground, help it to become profitable. And ultimately, we're trying to structure it out and try to perform it for 3 years, just to see kind of where we land. So the initial investment is going to go towards allocation of a couple of different items: equipment, inventory, website design, and of course, everybody's favorite, permitting, licensing, insurance, and point of sales costs. Right, so we have the sources and uses, this is something that we commonly will look at from a lender perspective when we're trying to contemplate potential deals with the client, right? So for example, like the use could be maybe like we talked about earlier, the one use could be equipment purchase, right? or it could be towards funding maybe build out of a property, a commercial real estate property. But this is kind of our starting point, just to make sure we know where all the money is flowing. And then we'll dive right into our Excel template, and we can kind of take you guys through the process, the iterative process that we would kind of look at from more of a lender lens.
Maybe you should have Hawaiian cows. That was true. It's fucking sure they'll know.
Keep it local.
Okay. Yeah, a little bit of an eye test here. Can you guys see this?
Yes.
Yeah?
Please. All right, so we'll take it slow, because there's, as you'll see in just a moment, there's a number of different steps that we take. So feel free, if you guys have any questions throughout the presentation, just raise your hand. We can be happy to kind of indulge. But first off, so our founding year, we're just projecting about 500,000 in revenue, about 300,000 in cost of goods sold for the chocolates. So overall, $200,000 in gross profit. So kind of retouching back to what we presented on. First thing we want to do is find that EBITDA number. So again, we have the net profit, and then we have interest, taxes, depreciation, amortization, which we're all adding back. And then we'll ultimately land on that $111,500 EBITDA numbers. This EBITDA margin is also helpful for us from a lender perspective because it kind of shows us, right, especially when you have historical analyses, year over year, how is the business trending, right? Is it trending positively, negatively? Is it stagnant? Kind of similar to what we would look at from like a profitability or even a revenue standpoint. And then next up, kind of like we presented on earlier, the proxy free cash flow. So we built out, taking the EBITDA number, and then we had all those other add backs. So taxes, distributions, in kind of CapEx. So you can see right here, right, founding year, we're going to buy all the equipment needed to manufacture chocolates. So it's a pretty large cash injection, cash expenditure towards the initial equipment that we're funding. You can see here, right, once we go through all the outflows, especially that large CapEx expenditure, now we're in a negative cash position, just over $400,000 in the hole. So what we want to do is contemplate, okay, are we going to fund it with debt or any kind of debt? So in this case, we're going to say, hey, we're not taking out any bank loans. We're going to just stick to investor equity. Right, okay, so perfect. So ultimately, from an operational standpoint, we're looking at a little over $400,000 in the hole, which we'll have to make up for on the working capital side, which is essentially kind of the churn, right, of our cash. I'll pause. You guys got any questions? I know that was kind of a lot to ingest.
Oh, we did. Yeah, Daniel started from like revenue and cost of goods sold, but that may be like what you're modeling for year one, because you have to really think about how much cash you need from your investors on day one to fund your CapEx and your pivot. So, we just created this really for illustrative purposes to try to drive some of the points home. Because we're getting to kind of a year one, and we're showing you how we backed into ultimately $520,000 of capital need. So keep going. Sure. So working capital, were you gonna cover some of the AR and inventory?
So just noting right here, this is at $407,000 that we look at from an operational perspective. And then from a working capital need, this is kind of diving more into that latter part of our presentation with the cash conversion cycle. So all we're doing is we're essentially just figuring out, okay, so based on the amount of working capital from the AR, inventory, and AP standpoint, approximately how much operationally we're going to need to support it at. So you can see here, and we'll circulate this. So I know it's a lot of numbers. If you guys want to check it out later, kind of how we got to these numbers, we'll share it with you guys as well. But ultimately, like I mentioned, right? So we have about a little over 112,000 working capital need. From an operating standpoint, we'll have about a little over $407,000, which leads us to that $520,000 cash need, which will be supplementing through that initial 520,000 equity injection, which we saw from the first sources and uses slide. So you guys can kind of see like as we perform it out, kind of where all that money, all the sources and uses are kind of deploying towards.
Does everybody understand the working capital need number?
Oh.
Yeah.
Oh, so
Okay, so hit the cell.
yeah.
Hit that 2 on there. Right. So your working capital need is going to be the values here: the 10, the 118, and the 15. Right. So what's a cash use versus a cash source? Your payables are going to be your cash source because you have to pay them. You haven't paid them yet. These are going to be your cash uses, right? So you need to have $118,000 for the inventory. So it's a
There is a B41 cash flow out.
B41 would be cash flow out. That's why that number is a negative. So 118,000, right? You need that number. You need $118,000. You're also going to need the 10,000, and then you're going to subtract the 15 because that's technically a cash source.
Then I say the B41 in the formula is this graph, right?
Yeah.
So sorry, just to adjust your question. Excellent question. That's the reason why we have to put the -1, but you're exactly right. So essentially everything that's plus is our cash outflows. And then in this case, the minus B44, which is right here, that would technically be a source of cash for us. But we just kind of did it this way because from an eyeball standpoint, like when you look at your balance sheet, it's generally going to be positive figures, like AR, EP, inventory. So just to kind of keep that flow, we left it as is and then just kind of backed it out with a party club. But you're absolutely right? So like Kyle was mentioning, AR, inventory, those are all cash outflows where we're basically supporting that cash. And then the AP is more kind of, it's helping us, right? It's more cash positive.
So if you go from 0 to 118, right? So it's like accounting, whatever accounting class that might be, right? You go from 0 to 118, that's an asset that's increasing, that's a use of cash. So you need that cash. Same thing for the AR, 0 to 10,000, use of cash. 0 to 15,000 on the payable side, that's a source of cash. So you just combine all those. This is you can make these two positive, this one a negative. Ultimately, that gets you to 112. There's more uses of cash. That's why that's a negative number. So you need 112,000.
By the way, how do you calculate the 38 and 41? How you get that numbers?
How do you calculate it? Oh, well, that one we might have.
Or is it assumption?
I think we made an assumption, Daniel, on the 118, the value.
Yeah.
Yeah, we had to come up with some assumptions of what you might have in inventory. It's more for demonstrative purposes, and then we're backing into the number of days is a calculation based on your cost of goods sold for inventory. AR is going to be on your revenues. Yeah.
Yeah. So kind of like what Kyle was mentioning. So you have your inventory number or the cost of goods sold. And then you're just basically translating it into day value. So that's the 365. And you have this. See. So just something to add to, in addition to looking at,
So can I know what the calculation was for?
That one we also, assumption, yeah. I think it's a pretty decent net profit number. So we're not gonna build out a whole P&L slide and then show you every operating expense. That kind of wasn't really the purpose of the class. So we had to start from, okay, you're gonna be profitable in year 1, and then we're gonna add back some of the things like depreciation, amortization, and get to EBITDA because we're focusing on that. But there's assumptions we just have to make for illustrative purposes for the class.
a good question because like if you guys have your own financial statements, you could totally just kind of take your income statement, take your balance sheet numbers, plug it into the calculator, and it'll populate, with useful values. So one more thing to add here. So in addition to looking at from our lens, looking at it from a historical perspective, we also look at it from a comp perspective. So something that was helpful is, if there's different resources that are available, and we'll share more shortly with you guys. But the resources are great because you can take your business and then compare it to, okay, how is the market performing, right? So in this case, like for example, the industry average for AR is 35, whereas the industry our personal business is performing at a 12 days. So the 12 in this case is more favorable. We're actually collecting our AR a lot more quickly than our competitors, which could be a huge advantage, right? Maybe that 35 days could be the difference between a competitor winning or losing, right? In a very stressful environment, stressful economic environment. Whereas if we're able to keep that 12-day clip, we're able to get the cash more quickly, and that could be the difference between survival. You have anything to add?
No, just every single finance or business owner, you should know what these days are. I mean, regardless of what the industry averages are, you should be knowing how fast you're collecting your AR every single month. I mean, these are the guts of your sort of operating and how well you execute on things. Your inventory days, like if you have 144 days of inventory and the average is 65, that means that the industry is operating with a leaner inventory, or they're selling their inventory more effectively than you are. So maybe your inventory is too fat, right? Like you're carrying too much inventory. That said, we do live in Hawaii and things have to be shipped here. It's kind of typical that industry average for inventory might be a little bit lower than most businesses in Hawaii because of that lag, and they want to buffer for that.
So this is for manufacturing, how assuming it's the manufacturer sector you build products.
Yep, absolutely. So whatever industry or sector you're in, there's going to be different industry averages for that for that market, and it would behoove you to research that to know where this industry is landing. Yeah, so if you have a product that's a digital product or only product, you're not necessarily inventorying that. You're creating that and then you're just trying to sell it, right? Like maybe you're creating an ebook or a content class or something like that.
Pretty straightforward.
Yeah, so that might be more straightforward. As you get like different businesses that are brick and mortar, combination of brick and mortar and online, and you're selling a product, well then, there's going to be more nuances, right? Maybe you're punching orders online, just-in-time inventory, or maybe you have a warehouse. I mean, there's a whole slew of different things that are going to apply, but at the end of the day, you do want to focus on your industry and how you're comparing to those metrics. And we're going to bring up some of those examples.
In fact, you want to just show right now real quick, just kind of how right out.
Sure.
Yeah, I mean, just because we're on the topic, like we mentioned earlier, there's other resources, right? So to address your question about like other issues, so just to give you an example, right? So like lawyers, kind of more service-based as opposed to manufacturing, which is our example. And you can see there's a difference, right? Major differences in the industry averages for their inventory AP days. It's really helpful, right? You want to leverage these resources to make sure that we're correctly benchmarking against competitors versus maybe other competitors which might not even be in the correct industry. So again, we'll circulate this after the presentation, but you'll see here on the far right corner, there are a couple of different resources here. I think most useful, especially when I was at UH, was the UH Manila Business Database. I'm not sure if you're familiar with it, but it's an aggregation of different types of resources that even we use. So they have like Mergent Online. I think when I was at UH, they didn't have Vertical IQ, but they had something else that's very similar, which allows you access to competitor information. And then this NICS search tool, this correlates with these numbers that you're seeing right here. So NICS is helpful because it helps you to correctly identify what industry you're in. And then you can take that same code when you're looking for your comp data and basically make sure that you're finding the right comp set and benchmark against correct competitors for the values that you're looking for.
Every single customer that borrows money from the bank, we assign a NIAX code to that business, every single one of them. And we have the resources to look at your financials, and we compare that to the industry. We compare your profit margin, your gross profit margin, your AR days, inventory days. We look at all of that. So that's what we're doing, and everybody should be doing that for themselves. You should be knowing where you stack up within your bucket.
So just to give you a quick sneak peek, so this Vertical IQ resource that we use, this is something that ASB specifically uses, and I think a couple of the other local shops use it too. But I'll give you a quick just look at that so you can see kind of what we're talking about, right? So like this is an example of like industry reports that are readily available and can help you guys with like research, kind of finding out, okay, where are competitors in our industry kind of landing with regards to any kind of economic stress, headwinds, tailwinds, or even just financial benchmarks. So for example, like what we're doing today, we have used financial benchmarks, and then you can see, right? So this is kind of where we're sourcing some of the data and kind of historical. So this is helpful if you kind of want to get like an average, or maybe you want to look, okay, 2020, that's kind of when we were in the depths of COVID. How did the businesses perform? Any kind of improvement that they show, does it show on our business as well? So they have different ratios. Super helpful is also like the gross margin. That could be a good point of reference. Cost of goods sold as well. And obviously the EBITDA knowledge we've been talking about is also really super helpful on that front.
Yeah, so very important. If your gross margin is much weaker than the industry, well, maybe your suppliers charge you too much, right? Or maybe you need to find a different supplier. Maybe you haven't scaled up large enough to get some of those bulk discounts, right? You'll figure out where all those reasons are, but you got to know where you are. You got to know where you stack up. Okay. How are we doing on time? Do we need to kind of speed this up, or?
Y'all, take your time. You have a lot of time.
Let's go through the next year then.
So that's
Sure. Next year, you grew 100%. Amazing. You have $1 million of revenue. You've maintained your same gross profit margin of 40%. So now we do the same thing. Now we're going to look at the waterfall of numbers here. Your net profit doubled, so you pretty much maintain your same net profit margin. You get to the EBITDA number, okay? And we're scrolling down, okay? So here's our EBITDA. We're going to subtract the taxes owed. And then here, CapEx, $50,000. Okay? You grew 100%. Probably needed some additional equipment, some additional CapEx. So we made that assumption in there as well. Scroll down, working capital. So we ultimately get to a number where, and this should not be a surprise, your working capital need is now $139,675. Why? Because you grew a lot. Normally that does indicate that you will need some more money for your working capital. You need more money for your inventory. You need more money to float your receivables, and you haven't been paid yet. So you do the same formula and you get to a number, 139,000. Your cash flow was 120, so it didn't quite cover all of it. So you need more money to capitalize the business. Where are you going to get that from? Equity or debt? Those are really your two sources. So we assumed an equity injection, okay? Remember that sustainable growth rate? I mean, we didn't compute it here. It's a little tricky to do that, but essentially what this tells you is you grew more than your sustainable growth rate. The internal cash flow generation and retained earnings from your business could not float this much growth. So you needed excess capital, okay? So that's kind of the takeaway there. So what happened in year 3? We're still growing, man. This is a great business. Swiss chocolate, Palo. Amazing. You want to take it? Definitely year 3 and kind of what happens. Sure. This meeting, short, ended after 40 minutes of idle time.
Okay, they didn't end up coming, so.
Oh,
we're done.
Yeah, so kind of continuing along with that revenue growth story, right? So we're still having some pretty great growth, another 50% growth year over year. And you can see we just left the COGS stable, so it's at 40% gross profit. And it's kind of going through that same waterfall, right? So I won't read it off to you, but you can kind of see, right, as we continue along, there's certain areas, right, where we're going to start to see upticks, right? So we have taxes owed. And then in year 3, something that's a little abnormal from the previous 2 years is that we decided, hey, I think we're doing pretty well. Let's take a $25,000 distribution, right? She gets paid for the work. So we distributed $25,000. We still have that CapEx of $50,000. But overall, we're still in the positive. Operationally, we generated a little over $142,000. So much better than the previous year, right? By about $20,000 to $23,000. Again, we assumed, okay, we're not going to take on any debt. Great growth perspectives. Doesn't really seem like we have a need for it. But as we continue along and we take a look at our working capital, again, we can continue to see, right, working capital need continues to increase, and that makes sense, right? It's correlated with the growth that we're seeing. So AR, even the inventory is starting to pop up, as well as AP. The one thing that's really positive though is the AP, you're seeing it's growing. So this is a source of cash. So that's something that in a way, it's not a bad thing, right? That's growing, because it just means that I have more time to pay my suppliers. So they're footing the bill. It's basically an interest-free loan. Whereas in this case with our AR, we're also seeing the AR is going up, right? AR days, which could be telling us, hey, like, why are we taking so long to collect cash from our customers? In this case, maybe because part of the story for our growth is attributed to wholesale orders, right? So maybe we're selling to like hotels, for example, and they have more favorable contracts because they're buying more. It's the Walmart story. So instead of paying us in 7 days, they're paying us in 30 or 60 days, right? So that's kind of creating a little bit more of a cash need for us, where at the end of the day, we can see down here, we have a working capital need of just over $142,000. Now, funny enough, it balances out with the cash flow that our operations is pumping out. So in this case, is there any kind of equity or any kind of cash shortfall or cash surplus? No, it's actually completely zeroed out. So thankfully for 2023, year 3, we don't need any kind of equity or debt injection. And we purposely did it this way. It doesn't always line up, but we figured it would be a great kind of scenario to show, like, hey, there are different levers that could be pulled, or in this case, right, where we even when we have that $25,000 distribution, it is possible, right, to grow at a steady pace, to pull out a little bit of money from the operation, and yet we're still covering ourselves from a cash basis, and we're still healthy.
Yeah.
So in the last year, we changed it up slightly. So we decided, hey,
grew 100% again.
we want to continue this growth rate, but we might need a little bit of excess cash, additional cash from outside sources. So what we did was we injected a $75,000 loan. So as we go through it, we'll kind of point out some of the areas that have changed as a result of this new $75,000 cash injection from the bank. So again, cost of goods sold, pretty static, gross profits at 40%. As we continue along, kind of standard stuff, with the exception of interest expense. So you can see now that we're paying interest on this new bank loan. It's an add back, right, to help us to sort our EBITDA number. And then ultimately, continuing along, we have a major CapEx expenditure. So in a way that makes sense, right? So we borrowed money because we knew there was going to be a major CapEx expenditure of just over $200,000. So that's going to help to support that potential cash need.
If you pause there, like, to this point, they haven't borrowed money, right? So in 2024, we're going to look at the history of cash flow, history of EBITDA, and we're going to look at your CapEx too. But we're going to look at this. This is the potential, right? This is the projection, which is great. I mean, they basically less than double the EBITDA. But, this is a huge, so we're not necessarily going to lend on this. We're going to be lending on this. And, a bank typically needs to see 2 to 3 years of history. So to address that earlier question on what, in this situation, what we would look at. And then if we take that metric of 3 times, yeah, we might be willing to lend a lot more than $75,000. But in this case, this business didn't need to borrow $600,000+. They just needed to borrow $75,000. So that's all they did. We're just kind of doing illustrative.
What is the marketing distribution speed? Right.
I think Daniel just chose to show that the business had a cash flow to make a distribution if the owners wanted to take it. There was cash flow available for that because in year 2023 they didn't borrow any money. We kind of made it a 1-for-1 where the cash needs of the business and the cash retained from the revenues were sufficient to cover each other and make a distribution. Because I think if you scroll down, I know you wash out. Now the owners are typically paid themselves a salary, so the $25,000 is extra, but it was really more like not needed, and they were able to pay themselves a distribution. And then I think in this 2024, it was still high growth and it still needed money. So owners shouldn't really be making a distribution if the business needs money. In this case, they didn't put in equity. They decided to borrow from the bank. And the reason why we show that is because this business has now matured. It's still high growth, but it has some season to it where it has a number of years. So that's usually you're going to be creditworthy to a bank. We're going to look at this and go, okay, you're executing, you're growing revenues, you're making profit, you have positive EBITDA, yeah, we can make you a loan.
Yeah, just to add to what Kyle shared. We purposely, again, this is kind of more demonstrative purposes, but we wanted to model out different scenarios just so you can kind of see like, hey, here's the different levers that we're pulling from a cash flow perspective and kind of the outcomes that you could potentially expect, right? So like distribution, I mean, obviously we're all in business to make money, right? So like distributions is king, right? If we can pull out some money and like enjoy it, business owners love that. So, you know, we can kind of see, right, like, hey, it is possible if we're performing, if we're managing the cash flow perfectly, you can still take out a distribution and still have no cash need. And then like how I mentioned too, right, in 2024, this is, especially with the $200,000, that major CapEx expenditure, kind of having that foresight of knowing, okay, we're gonna need to spend this cash, so do we wanna inject more investor equity, investor capital into this, or could we potentially take advantage of a bank loan, which is also a cheaper source of cash, and we can kind of stretch it out in repayment terms, stretch it out over a number of years, while our business continues to grow at a pretty expeditious clip. But again, kind of just different scenarios. But no real reason for the distribution other than that would be kind of cool to fix my account. So, one thing to add though, for this pro forma debt service, so this is something that, from a bank perspective, is extremely important to us. So in the previous 3 years, they didn't have debt, so we didn't really focus on it. In this case, because they took out the $75,000 loan, this is becoming of utmost importance, this DSCR metric, debt service coverage ratio. And basically what it is, I can show you the formula. We're just taking that cash flow before debt service, so that includes, you know, adding back the interest payments, the taxes, depreciation, amortization, etc., and then dividing it by the annual loan payments. That includes any kind of principal, interest, loan payments to get to this ratio. So in this case, 15 times is actually pretty good from a bank perspective.
That's amazing. We don't see a lot of 15 times.
Yeah.
It's more like 1.5, 1.7, yeah, for businesses that are borrowing a lot of money through the bank. What was the formula for that again?
I gotcha. So it's you're taking that cash flow before debt service, so your EBITDA number, and then any kind of additional sources and uses of cash, like taxes, distributions, etc., and then you divide that by your annual debt payments. So essentially, what it's saying, right, is how much in cash flow is the business producing in this specific time period over the amount of debt obligations that it needs to pay on. And higher is always better with that ratio.
This is a little bit of a conservative metric, this formula, because we're deducting capital expenditures and we're deducting taxes. Not every lender does it the same. So, you know, it's not like a consumer mortgage for personal residence where every lender will look at all the exact same metrics, debt to income. When you start to get into commercial and business lending, there's a little bit more of an art and more subjectivity. So a lender might take EBITDA and minus just taxes, that's it. And then they'll take that number and divide it by the debt service. So a little bit more wrinkle there, but the method that Daniel shows you is a conservative method, and you probably always want to look at your metrics conservatively. I would say that the big takeaway here is you have revenues, you have operating cash flow, we're deducting taxes, we're deducting cash outflow for your capital expenditures, and then we're looking at the working capital, right? Your cash conversion cycle, your AR, your AP, your inventory, right? Those would all be things that you should know and you should be aware of, and that's really going to give you sort of your free cash flow once you take all those other components and you mush them together. And then you guys should be doing that without freedom business.
So ultimately, you can see in that year 2024, despite the pretty substantial amount of growth that the business is still accumulating, and of course, like we have the bank loan that we're now paying on, we still have a cash flow positive situation. So just over $8,000 of free cash flow that we can utilize, whether you want to take a distribution or you want to keep it in the business, maybe deploy it in some other fashion, or just retain it. But overall, you know, it's a positive. It's just kind of the positive direction that we want to see within kind of businesses that we're looking at, you know, when we're contemplating a potential goal. Anybody have any questions? I know that was quite a bit to ingest. Any questions? Sure.
So for example, we are a startup company. Like, so how many years should we do for the forecast of our cash flow in the statement?
What kind of company?
Like we are a startup company. We would like to provide service to aquaculture farmers.
I see.
So like how many years should we put into the forecast for the statement?
Okay, so bare minimum is just 1 year forecast. For a bank, what are you going to do next year? Because banks we're going to discount your projections. Year 2, year 3. It's like, it's 2 years away. We don't know. We're really going to look at what you did historically, and we want to know what you're going to do next year. And then when that year happens, we're going to go back and look, how did you do compared to what you told us you're going to do? And that matters from a credibility standpoint, because if you don't hit that projection, right, and you're always below it, and maybe your debt service coverage ratio starts to become marginal, then we might be like, okay, maybe this person might be too optimistic, and maybe they can't execute on what they say. Conversely, if you exceed your projection, then we're going to be like, okay, well, they might be conservative. They're obviously executing. They're growing faster. So, there's maybe more of a credibility on the line, and how we're starting to get into how the business owner thinks and how they execute, and that can matter. Now, if you fell short of your projection and your debt service coverage ratio is 10 times, I don't care, right? It's like, okay, you're obviously demonstrating the repayment capacity to repay the loan. Even though you didn't hit your projection, which was maybe way up here, you still are really strong. So, there's a caveat there. Right? It's ultimately what can the business repay, and if it's very healthy, I'm not really going to care if you miss your projection by 10% because that's your equity return, right? I mean, that's you as an investor, how much you can distribute and how valuable is your business. But if you're comfortably able to repay the loan, that's going to be okay. So, there's also a different lens of how much debt and leverage in the context of that projection that the data foots.
Thank you.
Another nickel dozen. Okay.
Sorry, I guess this is a little not exactly to your guys' topic, but it seems like EBITDA is more relational to like a business that essentially is established and is trying to expand. I think for a lot of us are essentially startups that have zero sales, are tossing it out as we go, and are essentially writing the business plan before we even have the business set. So like to even have EBITDA, how do we create those standards? Because essentially what the banks are is investors, right? So how do we like quantify like, hey, we're nothing right now, but this is our market size, this is our potential sales, this is our potential this and that. But like you said, that's like all essentially fluff, and I don't want to say BS, but like BS in the way guy, I think you'll have to start with data. And that's I don't know, majority of us, but I'd say like we're all like startups there, so it's like, how do you quantify that for you?
I think we were giving a class and sort of overlaying sort of real world realities of what happens. But for a business as a venture and a startup, I think it would be impressive and notable if you did model out your projection 5 years or whatever, and you're computing EBITDA, and then what your industry benchmarks are. How you compare to your peers. And if you overlay that, so from a business plan, competition, and also just from the business plan for yourself, I think that would be good to do. Because if you're successful at your business, whatever you're doing, you're going to be quickly finding yourself in year 2 and year 3, and you're going to have revenues, you're going to have profits, hopefully, and you need to be hopefully zeroing in on some of these numbers. But yeah, for the audience that is just the venture and your startup, you're not necessarily going to be thinking about this, but you'll quickly have to if you have a little business.
Yeah, just that's what Val said. And I think you mentioned it in your question about, in this lens, the bank is technically like an investor. I think it's kind of the same thing, right? So just approaching it from, rather than looking at it historically, like looking at it on a forward basis, right, with your projections. But more importantly, I think, I don't know if you guys watch Shark Tank. You guys watch Shark Tank? Yeah, okay. Like, Mark Cuban is always like, sales is king. it's true, right? But in this case, right, if you don't have sales, like what are you selling? You're selling to your potential investors, right? So like it also is like in addition to your performance and your budgets, it's how compelling is your argument and your belief and your art, basically your business that you're selling to these potential investors to believe in you. And then like how I also mentioned, right, execution, right? So like, okay, if you sell your investors and they do believe in you and they invest some equity into your business and some cash, are you executing? Because the credibility standpoint to those investors is exactly the same thing that we're looking at as lenders, right? We want to make sure that whoever we're doing deals with, are they credible? Like, do they have good character? Are they actually executing on what they say they're going to do? And if you can do that, then the rest will kind of just take care of itself.
Thank you.
Yeah, there's different, EBITDA is probably the most common and applied metric, but, for different types of businesses, tech or software, typically a multiple of revenue for valuation is what you might see there because most of them are not necessarily making profit. So there's different nuances there. If you had your own YouTube channel, I think some of those actually transact and they sell, right, based on revenue and viewership, and hopefully your content is clean and whatever copyrights and there's things that matter there too. So we didn't get into those situations. We wanted to show you this is what we do at the bank. We are dealing with more mature businesses, but some of them are 5 years old. They're not that seasoned, but hopefully you guys found Weeks cool.
So I've heard it's maybe a little bit out of scope now, but there's a net operating income or IRR or cash on cash that's used in commercial real estate loan. So in corporate loan, since it's just a totally different way, like you mentioned, like you introduced today, or we also use that a little bit to see how the company or how the projects work.
To start with the beginning of that, a net operating income number is basically synonymous with EBITDA.
Yes.
But net operating income is used more in commercial real estate lending, and we do that as well. So that is sort of the sister of the EBITDA number on the real estate side, and then you're going to be making some different variable assumptions there, right? So on a real estate investment, where you're owning real estate and you're renting it out, we're going to assume maybe vacancy rates, right, which might hit your revenue. So that's what a lender would be doing there. We're going to take your NOI and then we might hit you with a vacancy, like a phantom vacancy expense, because we're going to look at the markets and industrial, retail, office, whatever your asset class is. What is the vacancies in the market? We have all that data. So we'll be doing different variable tweaks on a real estate side.
Yeah.
And then kind of just to piggyback off of Kyle sharing, I think overall, heart and soul, like what we presented today, kind of that cash basis mentality is important from a commercial real estate lens. But also, I think we alluded to it too during the presentation. There is slight variability, like specifically with the debt to EBITDA ratio, that it will be different because the asset is somewhat, coveted, right, with real estate fees lending. So we would look at it slightly different from a debt perspective. We might be willing to lend a little bit more compared to the NY value, but overall, kind of the same thought processes that we shared today, we kind of mirror it with a CRE loan.
Just a follow-up real quick. So if the fellow captain, the company, your example, they decide to invest in a warehouse, do they go to you, a corporate banking, or they go to commercial real estate firm and the bank?
They would go to us. So most of the loans that we make in corporate banking are real estate loans. But the difference is on the commercial real estate side, those are typically investor loans. We deal with the owner user of a business. So if a business wants to buy a warehouse and they're going to operate it, they're going to have their equipment, their inventory, we're looking at the repayment ability of the business. On the commercial real estate side, we're giving you a little bit more details into how a bank operates. Those are typically individuals that are buying warehouses and they're leasing it out to other businesses, right? They're tenants, right? So it's an investor loan. So that's kind of the difference. But yeah, I mean, I don't have the numbers with me right now, but probably 60 to 70% of the loans we make in our department are real estate secured. We're helping businesses buy real estate so they're not paying rent anymore. Because typically that's a good trade-off. Right? You get depreciation, you get tax shelterability. You're not paying rent. You're controlling your own destiny with your real estate. You can make your tenant improvements, customize it how you want.
So you user owner versus investor.
Yes. So user owner will be in our shop. Investor typically is in the commercial real estate shop.
Thank you so much. It was an amazing presentation. I was wondering if you have recommendations of additional resources for businesses and the established business that allow for this kind of detail to play with. And that is, I have like really basic bank and I'm a solopreneur, but you broke it down into so many different categories. So I was wondering if you have any resources that you would recommend in terms of applications or anything else that was in your
More like bank related resources or just overall like just business
overall business, financial health of your business.
Yeah, so so we can we'll share our stuff with you. There's also organizations locally that help. So SBA is one. There's an organization called SCORE, and then the Hawaiʻi SBAC. If you Google it, you'll find it. They're usually like either 1 or 2 on the Google search list. But my mom did that. Like she was trying to do like a small little sewing. I mean, it's small. It's basically her and a friend here. Like a sewing business. And the SBDC, their office is actually at Manoa Marketplace. They're really helpful. They offer seminars like this where you can kind of learn about topics. If you want to go into like consultations and stuff, you can schedule an appointment, but be a good resource. Especially for kind of up and coming startup type businesses. So they're really helpful.
Thank you.
Yes, the Chamber of Commerce might have some stuff. We might have additional classes to Chamber of Commerce Hawaii.
I was thinking more of like AI based.
Oh, yeah.
Something that is out there and it punch in the numbers and it does the formulas for you or it does predictions, and that's what I was thinking.
Ben, that world is going to be rapidly changing. I don't have anything off the top of my head that I'm willing to sort of say in this type of forum until we can really vet it and see our customers use it. So I hesitate to that, but yeah, it is an exciting time for businesses to kind of get that financial sort of component to supplement and automate and do things for your business and ingest the numbers and that one.
I have a question. So, related to uncountable startup businesses, for example, you mentioned about the YouTube channels. So, I would imagine for simple YouTube channel, let's say cooking things, they don't need the money, they just do it in their kitchen, and then they probably make some money from YouTube. But what kind of client you're dealing with need to lend money to the YouTube channel, and then you have experience and like you share with us some examples for uncountable kind of startup.
Well, we've never led to a YouTube channel.
That's what you say that. I was like, is that it?
That comment was, I know that YouTube channels they can be sold.
Okay.
There's
Oh,
a
yeah.
value there, right? Based on a multiple, I think, of probably their revenue and their views, right? Because I know there's a monetization behind that.
It's really complicated.
Yeah, I think there's a lot of media actual companies that end up owning different channels.
Yeah.
And they aggregate, they buy them.
Most of the money is paid merchandising things outside of YouTube or cloud good for sure.
So maybe EU will have better plans, but from a bank perspective, especially in Hawaii, Hawaii is not a large media tech industry per se, so we're not necessarily lending much into that sector. Yeah.
So do you have like an idea of a percentage over your client? How many percentage is accountable, like factories and candy shop? Those are very common with the understand. You have like percent, like only 1% is uncountable product, things like that.
Yeah, good question. I don't have that. I don't have that data handy on top of my head, but I can tell you based on the makeup of Hawaii that most of our customers will be business services. That's most of what Hawaii needs. You have our big companies like our banks and our, I was going to say airline, but they're owned by us. But and then you have like 1,000 companies that move stuff and retail. there's very little manufacturing. It's mostly warehousing, distribution, business services, hospitality. So we have a lot of loans to hotels. So it's kind of the economic makeup of Hawaii is where that answer is going to be. There's government, federal contracting, construction. So that'll be significant.